All right, everybody, welcome. My name is Sean Pritchard, and it is a little bit past February 1st, even though it's what it says. And this is my Super Shoppers data analytic presentation for my Capstone project, QMB4900. So this is the initial data analysis to discover points of failure and loss within the company. Here's the initial analogous subject, and these are the points that we're going to go over. We're going to go over the analysis, the findings, summary of the issues, and some of the proposed solutions, and then links to my analysis report. So let's get into the analysis. First, let's go over the basic information. We got 3 department categories, which is the store, the warehouse, and the accounting. And there's 10 stores, each with point of sale in them. Then they are decentralized, but we'll get into that later. The inventory items, these are the main categories. There are kitchen products, bathroom products, medicine products, and office products, with a total of 26 products altogether. Now, the top selling products I found through my analysis across all stores in comparison were hand soap, vitamins, and window cleaner. You can see here, this is top selling products in order through all 10 stores. Now, the worst performing products were pencils and cleaning solvent. Now, pencils have had 0 sales in 8 weeks, while cleaning solvents have only sold 5% of their inventory worth within that amount of time as well. So they are items that we're going to discuss here in just a moment that are not performing too well. All right, so let's go ahead and get into the margins. Based on the categories, each category, main category, kitchen, bathroom, medicine, and office, main categories, these are the 20% combined margins, and these margins were accumulated and derived based off the warehouse study that I used. I've also went a little bit further and calculated some gains, some profit, some loss, and the average profit margin amount, which would be 70 cents on the dollar for every product. Now, it seems that, this is a pretty fixed value. In a real inventory scenario, you're going to have, all products are going to be a little bit more dynamic, in a sense that you're not just going to, put a 20% margin on every product across the board, because, as you're going to see, some products perform better than others, and you want to be able to, capture that with consumers, and you want to be able to, make a little bit more money off products that are worth being sold for a little bit more. So here's my overall analysis, the combined analysis, and you can see here that there was $30,000 worth of sales within 8 weeks in all 10 stores. The sales margin, or the ROI back from that, it's the same calculation, just a different name, was 20%. The gross margin technically is 16.7%. That's what I calculated, but we'll go with the 20%. The profit from all stores combined was $5,011. And then we calculated the out of stock. Now, I calculated out of stock, which was a tricky calculation, which I've included in my spreadsheets, which basically counts anytime inventory was 0, and if it was consecutive, where there was a 0 next to a week. There's 2 weeks in a row, like week 1 and week 2 had zeros in them because it wasn't refilled. If they're consecutive like that, then we just added the amount of products that were out of stock based off the initial one. So we didn't count 2 zeros, we only counted the 1. But I have those separate calculations. But basically, out of all 10 stores, through that 8 weeks, there was 467 out of stock items across all stores for that period of time, which isn't really good. Now, here you can see that I've allocated my metrics in this little table here, which you can view later. I'm not going to go too much in detail, but we are going to know that this chart is individual store broken down, which basically shows the out of stock. That's what I'm using to denote OOS. This shows each store through the 8-week period of time, how many times they were out of stock. Then the accumulated sales, I used a little formula to calculate all the sales based off the products sold, and had to count the inventory. Then we accumulated that into the total amount sold, with the total amount of cost of goods. This is the product that it had. Now, since we only had the information of what it actually cost us in the warehouse, we don't have no overhead information. We don't have any information that tells us what other costs are associated with this. We just have the basic marginal price of what we are getting this for from our distributor. So that's kind of the only thing I had to go with. So we're lacking information, so that's what this is insinuating. But either way, then we calculated the total profit, the ROI of 20%, and I calculated a net loss. I calculated based off of all the weeks that were out of stock. I went ahead and I calculated what loss that would be based off of those weeks being out of stock. And as you're going to see, there was a lot of stores who went several weeks with being out of stock of products and completely missed a lot of sales opportunities. And that's what this net loss is representing here. And then it shows here the best selling products from each store, the most frequent selling products, I should say, even if they were out of stock, from both the worst products and the best selling products. So it was scouring pads and pencils across the board there. So here's another initial breakdown for my margin percentages, where basically this is the 8-week breakdown. This is everything summarized, and then I have it divided into weeks. So we can see here that the total number of sales between all 10 stores was 6,519. There was over $30,000 sold, and this is all accumulated within that 8-week period of time. And then I went ahead and divided it by 8 and broke it down by week, so we can get an even distribution of what the estimates would be for the total amount of products sold, which would be 815 across all 10 stores. There's $3,758 for the product sold, with a total profit of $626, and therefore we were able to get into some more metrics, which I have outlined in my actual analysis document as well. So let's keep moving forward. And here is the warehouse analysis, and I wanted to put this on here to show that I broke down the margin by case, then I broke down the margin per unit, and then I broke it down even more to subtract that unit, and then I calculated my gain and my loss. The calculations that I used in there are in the spreadsheets, which are attached to this video and to my actual presentation, so you might want to have a look at those if you are concerned about them, or if you want to know how I did it. Plus, they are written down in my analysis, which is pretty thorough as well. So now we're going to go ahead and get into the findings. We just did the analysis. Now let's move on to the findings. And our findings here, we're going to talk about findings between the point of sales, accounting, store locations, and the warehouse. Now, initially, the top 3 out of stock products that I found, not top selling, were dishwashing soap, ink refills, and scouring pad. Across the board, I found that these products themselves were initially running out week to week. So these were missing a lot. And we see that dishwashing soap and scouring pads here in a little bit, they are one of the top selling products. And being that, Super Shoppers is not stocking their stores correctly, and they have to go weeks without these products, they're losing out on money by not having these on the shelves. Here we can see a frequency stock of basically all the products here. All the products ranging from scouring pads, ink refills, and this is kind of a distribution that I created to kind of show, the range of what products are out of stock most frequently. We can look at the 26 different products here, and it shows us each item which has been out of stock within the 8-week quarter period of time. So, findings. Initially, we got stores with stock out issues. This is a major problem. We got reorders not being filled or meeting the demand of the consumers, and this equals loss of net gains. So I wanted to summarize that here because it moves into my next point, which is the individual store inventory. We can see here that scouring pads, notebooks, pens, and many different items that we can see here through this distribution for all 10 stores are typically, out of stock by the end of 8 weeks. Now, I went ahead and did some more calculations to kind of do an average, a mean average of what products are needed based on what products did sell and the amount of products that were out of stock. I calculated what the average product needed per week. So we figured, this for staplers, we would need an average of 8 products per week to maintain sustainability for that product. So if they kept up 8 products per week for that product, for instance, that would be an indicator for the warehouse and for the warehouse order point to know that, when it gets past 8, that it needs to refill. But we're also going to find out that in the warehouse, there's no systems in place for that, and the accounting systems are kind of archaic and old, and we're going to discuss that here in just a little bit as well. So I kind of ranked it down to the store's best performance. The best store 8, 3, 7, and 9. As you can see here, these have the least amount of stockouts. So I'm categorizing these as the best. Now, this is best based off stockouts, not off of profitability. And then the worst stores, which these do confirm to not only being the worst stores profitably, but they had the most amount of stockouts. And I went ahead and left my chart table up here so you can view that as well. On average, we have 57 times that products were missing from store 1 through that 8-week period of time, and the same with store 10 and store 2. So this causes issues because that means that products are not being fulfilled correctly. So this automatically tells us that we've got some some systems in place that aren't working correctly. So the warehouse findings, based off of this analysis and the findings that I have for the warehouse, I'm finding that it takes on average 2 to 4 weeks to fill orders. On average, it takes 2 weeks to process an order from the store to the warehouse, and it goes through this long accounting process, which we're going to talk about in just a minute. I found that on average, it takes the warehouse 2 to 4 weeks to supply a store with the products it needs to meet the customer demand. Also, when the warehouse sends products, they are only filling orders up to 5 to 10 products on average. More what I counted was 5 products. If it runs out and they max out of 20 products, well, they're only sending a specific store 5 products. They're not sending them the full amount, the full reorder stock amount of 20 products. They're just sending them 5 at a time, and some I measured at 10 at a time. So, if you're only giving 5 products every other week to stores, they're going to run out very fast. So there's some systems that need to be put in place because we can see that there's a lack of systems not being used here. So we got fixed amount of refill time, 5 to 10. We got top selling products, reorder points, which are too high, meaning that these reorder points for top selling products, they're too high. The benchmark should be lower so that the warehouse can trigger sending those products to the store on time. And they need to have, like I said, a higher amount of inventory for those products because they're best selling products, and just the opposite with the low selling products. We got reorder points that are just way too low. So that means we're triggering sending items to stores when they really don't need it. And as we see with the pencils, we've got pencils that are being sold across all 10 stores, and not one pencil has sold in 8 weeks. And then this leads to the conclusion of bad stock and inventory management systems. And I've got some solutions that we'll talk about here in just a moment. But you can see that everything I just talked about facilitates through this sell-through rate conclusion. Now, the sell-through rate is a calculation that I've thoroughly explained in my full analysis, and basically it is a calculation used to measure the amount of products received from super shoppers manufacturers against the amount of products sold to the customers in a specific period of time. In calculating it, I used the total number of sales, divided that by the number of stock by hand, and then multiplied it by 100 to convert it to a percentage. And then I threw it into this distribution here, and it shows that it supports my hypothesis that increasing inventory and lowering reorder points to specific stock items can meet the demand and increase overall profit in all stores. And that's exactly what this shows here. So in accounting, the issues that we found in accounting was that their processes are causing delays in stock, causing stockouts, such as in the authorization process that they use. They have a manual authorization process where they have to manually accumulate whether or not they have enough funds to process the order. And this adds on another week to the warehouse's 2-week turnaround time. With that, they have more methods that they're using. They're sending spreadsheets to the stores individually. That means these are points of failure, because if you have 10 stores and you got to write a spreadsheet for each one of those stores to update the margin percentages on their products or tax rates or whatever it may be, then you're sending each of them a spreadsheet that they got to do manual data entry on, and this causes data entry problems. And throughout the entire data set, there was several different data entry issues where either a 1 or 2 was put in where there was supposed to be 20 to fill that week's inventory stock amount, but there wasn't. There was a lot more. It showed 120 on some, it showed 50 or 60 on others, and that is because of human error. And that is my assumption, but that's what it looked like to me because when you send people a spreadsheet and you tell them that they got to manually enter these on all these servers set up individually at each store because you got a whole decentralized system, then nobody's on the same page, and there is profound room for mistakes that do occur. So, like I said, no sign of formal systems or lean metrics such as EOQ and SQ, continuous review, fixed order quantity systems are even being used. As demand arises, items are withdrawn from inventory, and simultaneously the inventory position is updated. That is the type of system that needs to be in place, which is not. The analysis shows that the leading cause of this is due to several factors, including the accounting departments, such as all stores use their own servers, have to do their price updates manually, like we just talked about. The accounting department's got to send them a spreadsheet. The cost of time is very ineffective, whereas if we use the centralized server system or a cloud server system, it would take less time. And another main factor is that this accounting process, throws a wrench into the turnaround time for all of these products to get back to the store. So let's move on to the next one. So we're going to go over the main issues. I'm just going to recap on all the main issues in a list, and then I'll give you the final solutions and recommendations. So the data analysis issues. The key issues that I found is that we have way too many out-of-stock averages that are way too high across those stores. Basically, the out-of-stock averages at stores are too high to meet customer demand. Stores 1, 2, 10, and I even threw 7 in there as well. The out-of-stock averages for these stores is 3 to 4 weeks, which means anywhere from a 37 to 50% of revenue loss on all those products. The out-of-stock on average is 4 weeks. The turnaround time is on average 4 weeks before stores actually see products getting in their stores. So that means that there's stores sitting there with empty products or empty shelves that are being fulfilled for 3 to 4 weeks, which is a long, long time to wait, to get some inventory into your store. Like I said, the warehouse is only sending fixed amount of products, 5 products at a time, possibly 10 here and there. And that order takes 2 weeks on its own to fill it. And then with the processes that accounting has, you can add another 1 to 2 weeks on top of that. So that's where we're coming up with all these zeros and out of stock numbers for these different stores on these different products. We got too many points of failure because of this manual distribution system that just causes too many errors. In my opinion, we need a system that is centralized. We need warehouse system that is centralized. We need common practices, inventory management systems to be implemented, used, training, and all that stuff, which we'll talk about here in just a minute. The accounting processing systems, they use out-of-date techniques such as spreadsheets, outdated systems to check revenue values. This is where typos and accountability comes into play, and this is where mistakes are made. The warehouse reorder points, they are too high for best-selling products, and the inventory doesn't facilitate the need. And the same with the worst selling products. The reorder points are way too low, and the products have too much inventory. In some cases, I would recommend that there would be some products that shouldn't even be sold, like pencils. Now, another thing I wanted to mention is that there's no sign of these systems, but they're not implementing vendor outsourcing either. If they were to implement vendor outsourcing, it would lower inventory costs, warehouse expense, relief from inventory management, while optimizing fill rates across the products. And that is another calculation that I actually did in the data set. I did calculate fill rates as well to the best I could, so you might want to check those out. And I broke down my data sets into 2 parts. I did one that was a table data set, and then another one where I just used to accumulate all my measurements. There's one that I renamed. It says Capstone course data set, and then the other one, which I left the name for it, it just says Capstone week 4 data set, and I left that one alone, but I changed all the data. So I kind of broke down 2 data sets. It was easier for me to do it that way. So, all right. So the basic cost of all these issues that I based on my calculations is an average of 10.2% per year. That's 365 days per year. Sales margin, 20%. It's not dynamic. It should be fluctuating with the products, but it's not. It's just a set fixed amount that's 20% across the board, and that is not how you profit in a real world situation. Now, the loss in revenue per year that I calculated was nearly $20,000, as you can see here. So that is a loss all the way around from these bad practices and from these, this analysis that I've taken, that I've showed you and proved to you through the points in the data. Now, let's talk about solutions. Based on my initial findings, I believe these suggestions would be the best course of action. So we're going to discuss accounting, warehouse, and then the stores last. And I'm doing this for a specific reason, which you'll see in just a minute. So basically, these are the solutions that I'm proposing for the accounting. To implement ABC analytics, where they establish a minimum, maximum levels of reorder features such as ordering cycles, top, bottom seller identification, cloud inventory management. This will avoid human error, avoid those spreadsheets, and avoid having to rely on so many points of failure and employees not to make mistakes. Secondly, to implement continuous reviews, fixed order quantities, SQ control system that implements inventory positions of items and monitors everything continuously, where it is known at all times, where inventory positions are known through a system, and if store 1 runs out, then it knows to go ahead and send them a sufficient amount back. So an automated system. And we can only do that if we use the centralized system, using a centralized warehouse and network system, which I'm probably going to bring this point up again in the warehouse section, but I just wanted to let you know. We need a centralized server network, in-house system that implements digital cloud point of sale tracking solution. All inventories, updates are made immediately through these systems, and they're very minimal to maintain. Also, the systems for accounting to create efficient stock order cycles using technology as opposed to the current accounting process, which manually has to check revenue amounts to fulfill and approve orders, is removed and outdated. That needs to be gone. Such as sending prices and margins to the stores through these spreadsheets like that. They need to adopt a system that doesn't standardize the margin at 20%. Products need to be marginalized based off the performance, and they need to implement, strategies where they are actually meeting customer demand and being competitive. And we'll talk about that a little bit more once we get over to the store section. Implementing vendor outsourcing to low inventory cost, warehouse expenses, relief from inventory management. That's what I'm talking about here. And then implementing and tracking data through key metrics and indicators, adopting new KPIs. Some of them I'll go ahead and list off to you, but I've got all the ones that I think that are necessary for this company to implement, all in my final analysis, which is well written and it's really long. But it's based around the ISM instantaneous supply models using dynamic inventory control, stock stick inventory models, multi-inventory models, selective inventory models, implementing some type of model other than what they've got now, calculating metrics such as ROI, customer conversion rates, CI metrics, inventory turnover rates, and sales velocity. Now, these are all data points that can be gathered through the current system, which weren't provided in the data set, so therefore I know they need them because they're common practices within inventory management, and to implement these, we need specific data points, and to gather these data points would be something I will look to in the future for super shoppers. The warehouse solutions. We need a system that verifies receivables. We need to verify them with packing slip purchase orders through hopefully the digital cloud-based technology. If I was pitching this to the company, this is one of my main assertions would be to get cloud-based technology, use a point of sale system that connects with the accountables office like NetSuite or QuickBooks or something to that nature. Strategically implement warehouses, multiple warehouses from east to west, north to south, allowing Super Shoppers Company the ability to pull orders and distribute, to where it cuts down cost and time. Setting up multiple warehouses as opposed to one is going to pay for itself in the long run, and these are investments that I would highly recommend. Implementing lean processes to implement schedules, establish warehouse KPIs, category inventory, using the ABC analysis hierarchy, implementing reorder point formulas, just-in-time systems. These are things that I would also recommend. Centralize the warehousing server capabilities. Each store has its own server that it must update. They need a central network where everything ties in, and every store takes its cues from the main system, from the head of the network, not each other and individually. It should work the other way around. And right now, the way it's sitting, as far as I've seen, is it's a completely decentralized network that relies on manual data entry. Daily inventory assessments and analyzing processes using systematic inventory management techniques. This is something that really needs to be incorporated into the warehousing. This will require training staff to use technology and inventory management techniques. And finally, to adopt inventory management processes and solutions that will allow for the dynamic adjustment of reorder points and products. So that way we don't have 5 products going out when the store actually needs 10 or 20 of them. The system can tell the stores whether they're not selling a product and whether it might be more beneficial to take it off the shelves, because we got warehouse holding cost and overhead and all these things that products that don't sell actually cost the company. So finally, let's go to the store solutions. The first one is fixed reorder points. Again, most of these solutions have to be handed down in part by accounting and warehouse department through proper systems, proper technology to function correctly. But having that digital cloud system or a centralized network to implement a cloud-based point of sale solution is going to, relieve a lot of this tension. And for each store to fix those reorder points, and they can calculate them based off the performance. We need performance indicators for products as opposed just 20% across everything. Well, that's what we'll mark it up. There it goes. I don't see how you could even stay in business doing that, but either way. Like I said, implementing cloud-based point-of-sale solutions, very, very, very crucial. Drop non-selling products. Get rid of products that aren't selling, not performing. And having that point-of-sale system can help you determine these types of factors. Having the right inventory management systems can help you determine whether you drop or sell a product. In my personal opinion, they're not selling pencils. They have not sold none in 8 weeks. Now, if that was a full year of data that not one pencil sold, yeah, I'd probably drop the price on them or give them away at the door for free or something and stop selling them. Why are you going to hold on to a product? Because it's got to be accounted in inventory. You got people in the warehouse that got to take their time to make sure that they have it in stock and that the reorder points are met, even though it's not going anywhere. So you're taking man hours, overhead, a lot of things to take into account there that I could just think of off the top of my head. So dropping those specific products, very key. Arranging individual stores based on customer preference. Stores should be, arranged to fit the needs of the customers coming in for each location. And there's 10 locations, so each of them are in different locations, which have, different types of subsettings around them. And each of them can be set up different to appease their customers. But that's only going to work if you got a point of sale system and you implement some type of cloud-based solution or centralized network. But like I said, specific products from inventory, you need to keep the minimums on hand. You got to have the higher reorder points for products that don't sell, like pencils, and the lower reorder points for scouring pads and ink cartridges. And we can do this through implementing use of what's called the 5 S's: sort, set, in order, shine, standardize, and sustain. The 5 S's are a lean terminology. It's a lean idea framework used for inventory that I highly recommend the store considers implementing. Offer competitive pricing and price matching offers. This actually works, and the data shows that base rates and single inventory amounts are only shipped to a store at a rate of 5 to 10 products per cycle. So raising the cost of best-selling products to increase the margin while lowering the reorder points to implement those products on their replenishment is going to earn you more money on the back end. Then we want to talk about implementing, new scheduled training for staff and management to utilize these new systems, metrics, and technology. All this ties in together, as an ultimate solution that could take super shoppers to the next level, as opposed to where they are now. So again, solutions overview, basic points that I want to get off: integrated, centralized server network, implement, management solutions and inventory control practices, lower reordering points and higher others, get the inventory amounts correct and based off performance, implement new data solutions, remove products that aren't selling and holding the company down, and set up a point of sell system that doesn't require so much human error to be involved. Eliminate points of failure that cause human error. So again, these are just the key takeaways that I got, which I basically just gone over. I'm not going to read these out to you again for time's sake, but if you'd like to, go here, check out my points that I go over that we've just discussed in this presentation, and that is the end of my presentation. You can find all of this data and everything that we've discussed in my final data analysis, which is very thorough and very detailed. So if you have any questions, please talk to me and let me know. Thank you.